Hey traders, this is Blake Morrow with Traders Summit, and I have Mr. Jim Welsh of Macro Tides that he's with us. He comes here every single week, and we're so happy to have you here, Jim. Jim, how are you doing today?
I'm doing good. How you doing?
I'm doing great. It's Friday, and it's always nice talking to you, especially after such a crazy week. Obviously tensions are still running wild in the Middle East, and everybody's bracing for this potential ground assault in Gaza by Israel. Whether it happens or not, I think you and I both are not experts in the field, so I think we're bracing for what might happen. But I think the markets are really trying to get their handle around it, but keeping an eye on what's happening from a macro point of view and monetary policy standpoint. Speaking of which, Fed Chairman Powell yesterday had the opportunity to speak to the world at the New York Economics Club, I believe.
Yep.
And he had a big speech. So, I know we have a lot of charts we need to dig through, but I wanted to get your views on your takeaways from Powell, because we've had this march of FOMC regional governors. I think there's been 7 or 8 of them that have really expressed the idea that rates would stay high, and they're done. What were your takeaways? I'm going to shut up now. So what are your takeaways?
I think, again, he conveyed that the Fed's done a lot, as he does in every major speak. He repeats that they are committed and the resolve is high to getting inflation down to 2%. And so, again, my take has been, as you know, inflation has come down. It seems like most investors, especially Wall Street, is almost solely focused on inflation. And I think the keys at this point in time are overall GDP growth and the labor market. And GDP growth, you can kind of measure some of that with capacity utilization. At some point in time, we'll cover that stuff. But so I think he focused again on the need to get GDP growth below trend for an extended period of time, which implies that, okay, we've raised rates, we're happy where they are right now, but unless we see some real progress that GDP is slowing materially, and they're not going to get it with the third quarter. I think the GDP number comes out next Thursday. It could easily be 3.5%. The Atlanta Fed is like at 5.4. So there's, I think, some frustration, not just on Powell's part, but a number of the FOMC members is, okay, we've done enough. We're waiting for proof that we've done enough. And yes, inflation's come down. That's a good thing. We're seeing some modest signs that the labor market is easing, but we really haven't gotten to the place we expected to be at this point. And so to me, he set the table for we're watching, but if we don't get what we want, then I think we're ready to have to raise rates more.
So a lot of the critique yesterday, and I'm sure you heard a lot of it listening to a lot of financial news networks, is that the Fed is so data dependent that they're going to be behind the curve when the data starts to turn. How do you feel about that argument?
I think it's legitimate. I mean, if you think about it, I've often used the expression, the Fed is driving the car, looking through the rearview mirror. And that's great. You can do that pretty well if you're on a straight road. But at economic inflection points, the road doesn't stay straight, it curves. And so by the nature of the data itself, most of the data is 30 to 60 days old. It gets revised, fairly significantly. So it's almost part of the game that you're going to be behind the curve. I think the Fed is attempting and has attempted to address that problem, Blake, and they've couched it in the sense of we don't want to make the mistakes of the 1970s. Because in the 1970s, they would have continued to raise rates more aggressively than they have over the last 6 months. And I think this idea of first going from 75 to 50 to 25 basis points and then doing every other month is like, okay, we're edging our way toward restriction, but we don't want to tip the economy into a recession. And I think they're trying to increase the odds that that doesn't happen, or that if things really slow down, they won't slow down abruptly and deeply. So again, there's been special factors as a result of the pandemic, fiscal stimulus of $6 trillion, the Fed keeping monetary policy too accommodative for too long, supply chain disruptions, labor market. These are big issues that don't get resolved in 2 or 3 months.
Yeah.
And so, again, my take is don't doubt that the Fed will raise the rates if they feel it's warranted. Number two, the idea that they're going to move the target from 2% to 3% on inflation, I think is just totally wrong. It's not going to happen anytime soon. So it's kind of silly even to mention it. So again, I think they're going to see significant slowing in the next 3 to 6 months. We've talked about it for a long time. The pressure of all these rate hikes, lending standards being increased, all this stuff, I think, is really bearing down on the economy, starting in the fourth quarter and obviously extending into the first half of next year.
Well, I know we got a bunch of charts to get into, and we're gonna. The first topic is going to be the bond market, but I want to, before we go there, I just wanted to ask one last thing. Going back to the inflation target of 2%, raising it to 3%. That when you say it's too early, I think you're 100% correct. If the Fed did that, that means they admit that they can't, they don't have any control. A, that'd be one, but B, the Fed, it would make sense that their initial way they have to go is make sure they get inflation back below 2%, and then at that point in time say, well, we're going to raise our targets to 2.5% or 3% based on the current global environment we're in and what we're dealing with. But we've already wrangled it in. We've got it under control now.
In other words, they can only do that if they've achieved success.
Correct.
On the 2% target. And I think that is 100% right. The one thing when people bring this up, most people live to be, 78, 80 years. That's the average lifespan, right? So if you tell somebody, hey, the day you're born, something that you like was $1. By the time you reach age 72, it's going to be $4. Does that sound like price stability to you? And I think most people would say, no, it really isn't. Well, that's what happens if inflation averages 2%. Prices double every 36 years. So it goes from doubling to quadrupling in a lifespan. If you go to 3%, that doesn't sound that bad. Yeah, it means that prices will go from $1 and 72 years later be $8. Yeah. To me, that's what needs to be pointed out. The central bankers won't do that, of course, if indeed they change their target. Even the 2%, in my opinion, is wrong. I don't think price stability is prices quadrupling in somebody's lifespan.
Yeah.
So, but anyway, we're way ahead of ourselves.
We are.
They got to have the success first.
Yeah.
Because otherwise it's a complete loss of credibility.
100%.
Yeah. And there would be loss of credibility if and ever they ever go to 3%. But it'll be less so if it follows a success, as opposed to, well, we can't get it below 3%, so I guess that's the new target. That's failure.
Yeah, and I'm going to tell you right now, based on what I've seen out of Fed Chair Powell, it's not happening on his watch.
Nope. He made a big mistake with inflation transitory back in 2021. This is a very sincere man. I think he's worked very hard, and everything he's done, he's always attempted to do a good job. And I think for him, to your point, is he wants to really get this right.
Yeah.
And because he feels deeply that longer term, the majority of American workers will be best suited if inflation is closer to 2%. I think he says that almost every major speech. He repeats that. And there's a reason. He wants everybody to understand this is where my conviction is coming from.
Well, this is a great topic, Jim, and I'm sure we could go on forever and ever and ever about it. And I'm
But
sure some people would
it's Friday and we don't want to do that.
Right. It is Friday, and it's 5:30 a.m. somewhere, or 5:30 p.m. somewhere. It's close to
right.
it's closer to 5:30 a.m. where we're at. Anyway, let's get to
this is all vodka, man.
Yeah,
It's
same here.
you know.
Same here, pal. That's all I got. So let's get into the charts, and let's get into let's start by talking about the bond market, for crying out loud. I mean,
right.
I mean, what do you what are you thinking right now with the bond market?
Well, last week we showed a chart which showed TLT going back to like 2020. Yeah. And you can see 5 waves down. I mean, we're in wave 5 from that high at 179 and change. All right. What I'm trying to show here is if we woke up in the headline, tomorrow says, oh my God, the S&P is down 54% from its high. It's down to 2216. Everybody would be losing their minds.
Yeah.
But it's like people don't pay attention as much to this bond market, but that's what's happened. TLT, since its high in 2020 at 179.70, at the low in the last day, is down 54%. So if you take 54% from 48.18, you're at 22.16. I just wanted to show this to kind of convey the magnitude of the damage that's been done in the bond market. And last week we showed a chart that showed the actual price action of TLT from 179, and it's clear as day. 1, 2, 3, 4, 5. Now we're nearing the end of that wave 5, and we'll talk about that in a few minutes when we look at the daily chart of a TLT. But I just wanted to convey, folks, this is unbelievable. The impact for banks. All right. Remember, banks hold a lot of treasury paper.
Yep.
Mortgage-backed securities. So the losses that banks have on their balance sheet, and they have 2 buckets. Never going to sell this stuff, so we don't have to recognize those losses. And a separate bucket is like mark to market. If necessary, we can sell this. So Bank of America came out, and their losses in the last quarter went from I think 105 billion to 130 billion. So there's impairment going on, even if Bank of America and the other ones don't have to sell or won't sell that paper. But you think it has an impact in terms of their capital base and lending aggressiveness and so forth? I don't know how you could run a bank and it not, So the ramifications of this 5 down pattern in the TLT and treasury bonds, we've begun, in my view, a secular bear market. In other words, from 1945 to 1981, we were in a secular bear market. 10-year yields went from 2 to 15%, and then they went from 15% to 50 basis points. Secular bull market. That trend was broken.
And Jim, I have to mention, I mean, you think about the bullish trend, the secular bull market that the bond market was in. How many years is that?
Let's see, from 1981 to call it 41 years.
40 years, right? And the secular bear market in the bond market's been what, 2?
Yeah.
They call that up on an escalator, down on an elevator, right? I mean, that's truly what has happened here. And I think what you're trying to point out is the magnitude is so big. I mean, most people are like, oh yeah, but the stock market, oh yeah, but this is the biggest market. I mean,
it dwarfs the size of the stock market.
Yeah. I mean, it's not the,
I don't know if it's 3-1, but it's
market, but it's big.
Yeah, it's big.
Right.
Somewhere down the road, I'm going to go through the 60-40 allocation.
Yes.
And what does this secular bear market in bonds imply for that? And also, we've talked about the idea that the equities are probably, if not already in a secular bear market, will be after one more rally. But the ramifications of what's happening in the bond market, to me, provides a lot of support for the idea that a secular bear market in equities has either started or will start. Because let's not go into it, but there's a lot of implications.
All right. Well, we can't wait to see that. I know I can't wait to see it. I could speak on behalf of our viewers. And by the way, if you guys and gals are enjoying what Jim does, make sure you give him a thumbs up. Never forget to do that with Jim, and comment down below on anything that you
should
see.
should become a religious experience.
That's right. Always clicking. I love this guy. I love this guy. I love that guy. Okay, so let's
okay. So we're going to go through a couple of averages that a lot of people don't pay much attention to.
Yeah.
But I think if one wants to understand sometimes what's really going on in the overall equity market, and I think about 3-4 weeks ago, we looked at the Russell 2000, which delivered a pretty bearish message. And, obviously things are unfolding.
Here we are. Right.
This is the equal weight. So the top 7 stocks in the S&P, the Magnificent Seven, are 29% of the S&P. In the equal weight, it's 7 times 0.2%, so they're 1.4%. So when you look at this pattern, you can kind of see that, okay, there was an uptrend from the low last October, which was broken. We rebounded up. More importantly, you can count 1, 2, 3, 4, and now I think we're in wave 5 to the downside. Wave 5 will equal 1 at about 134, 132 and change, something like that. So, the low in October of last year was what? About 125. So in other words, we're seeing the majority of stocks are likely to get near their lows from last October when the S&P was at 3,500. So that shows you how much the average stock has been underperforming the S&P, and that top panel shows the relative strength of the equal weight S&P 500 to the S&P. And you can see it strengthened up into February, and then from there, it's just been weaker and weaker and weaker.
Yeah.
So again, this just says that if and when those Magnificent Seven stocks weaken, the overall market isn't in a place where you can anticipate that it's going to turn on a dime and become strong. The next chart is the value line. It's basically the same thing. Again, this is a non-capitalization weighted index, 1,700 stocks, very similar pattern. You can see, that the S&P got to a higher high than last August, I think. Yeah, it goes back there. This failed to do so. And then you can see 1, 2, 3, 4. We're in wave 5. The two legs are equal at under 498, I think. And again, we're approaching the lows from last October. So when I look at these charts, and then you ask the question, gee, do you think the S&P is going to take out 4216? Well, the broad list of stocks, as measured by these two indices, have already done that. So let's look at the S&P, and to me, the odds favor a drop below 4216. And if you look at the bottom panel, it shows an MACD on the RSI for the S&P. It's not oversold. It's nowhere near oversold. So, I'm
imagining here. I'm using my imagination.
You know what? You are really talented.
Thank you.
You could have been a graphic designer.
Thank you.
In another lifetime. So the point being is, the odds are, when you look at when it's gotten below the MACD on the RSI, below the green horizontal line, you've been near trading lows. We're not there. That implies potentially not just a decline below 4216. 1 and 5 would be equal under 4150. I don't know what the exact number was, but a touch under 4150. So to me, this is what is likely to happen. And the one thing I pointed out last week was that the decline from 4607, there's another pattern that you can say 1, 2, 1, 2, and we're about to go into wave 3 to the downside. And we talked about it, and you pointed out, wow, that would take you much, much lower, than 4,200. Yeah, absolutely right. And so if we drop under 4216, we'll know if it's wave 3, because it'll get.
We'll know when we're in it. Yeah, and we're all going, woo, holy crap.
So from a risk reward standpoint, understanding the implications of different patterns, Blake, should one want to be a bottom fisher
if
if
you're in
that's
a
a
wave three.
potential risk.
Right.
You know, you're going to want to see that you get a low put in, a rebound, kind of a retest of some type of that low before you want to shift and become more aggressive on the long side. I'm not there.
Jim, Confucius say that picking your bottom, you have smelly fingers. So
I didn't know that, there's an old recording out there of Queen Elizabeth when she was much, much younger, was going into Albert Hall. And the announcer kind of said something similar. All eyes are on Queen Elizabeth as she picks her seat. So I don't know if that guy kept his job or not.
Probably not. I'm going to say he didn't.
Have,
but all right. So
we got to move along.
So the implications are for a move lower in the S&P. Tell us about TLT, because there's got to be some safe haven buying coming in. You got the 10-year to hit 5%. I mean, what do you do here?
Well, again, to me, the big picture from March of 2020 is 1, 2, 3, 4, and now we're in wave 5. So now we're trying to dissect wave 5 and identify how low can TLT go. So if you look at wave 1 was 109.10 down to 100. And then the rebound, I don't have it on this chart, I think it was 88 and change. It implies you could drop down to 79.37. But again, I think we're nearing the end of this. So if we complete this 5-way pattern from 179.70, you start, okay, what's the 382 retracement? Well, that's like 100 points. So you're talking 38 points. Let's say it gets down to 80. That TLT, if it does a 382 retracement, would be 118. Wave 4 of lesser degree is 109 and change. So to me, this is where the risk reward starts to set up where, all right, I think you want to start to scale in TLT, knowing that it could drop to 79.37 or even 70, whatever it is, in a flush. But I think you're going to get rewarded, because I think as we get into 2024, the economy is going to slow materially. At some point in time, the bond market's going to anticipate that the higher for longer is over. And you're a lot of shorts in the bond market.
Lots.
And you got pension funds and insurance companies, buying the 10-year at 5% or whatever it turns out to be. We can't let that ship sail without trying to really be on it. So that's how I think you can get a very, very strong rally going into, let's say, the middle of next year, where TLT gets up to 108, 109, and maybe 115 towards 120.
Yeah.
But the 5 down, though, Blake, that pattern says, okay, that's the first part of a bigger decline. So whatever rally happens over the 6 to 9 months, that pattern suggests that you're going to have then another decline where treasury yields take out whatever the high happens to be on this when we finish wave 5.
Okay. All right.
All right.
So the issue, whatever happens here, we're probably going to at least make one more low at some point. Fast forward,
it might be 2025.
Yeah.
I mean, we're thinking big picture here. The point being is we're running a $2 trillion deficit with GDP growing above 2% for the last 4 quarters, I think. So in a recession, what happens? Well, the government does a lot of spending. Unemployment benefits start to go up. All the various support programs, increase spending. So it's possible that if we get a recession, that government spending in the fiscal year that would end in 2025, September, 3.5 trillion, 4 trillion. That's a lot of paper. So to me, that's one of the fundamental factors that supports the idea. We complete 5 down, we have a really pretty sharp rally, then we roll over and sell off again. And what could cause that? Obviously, an awful lot of supply.
Yeah.
Maybe inflation rate doesn't get down to 3, or
right.
Again, who knows what the scenario is. but that 5 down implies that that's the first part of a bigger decline. It goes back to a secular bear market has likely begun, So, Santilli or Telly from CNBC, who's kind of a fun guy to watch, but he's also sharp and informative. He had a chart 2-3 weeks ago, 13%. Sounds, like not possible, even to me. And I'm talking about, you get 5 down, you get a bounce, and then yield's going to go to a higher high. So either inflation proves to be a much bigger problem. Oil's at 150, God knows what causes it. But anyway.
Yeah, interesting.
So there's a buying opportunity approaching that could be a fairly significant opportunity between now and, let's say, next summer, when things really slow down. The Fed is anticipated to cut rates, then they actually do cut rates. TLT could have a move back to 105 to 110 from the low 80s. That's a great trade.
Yeah, right. Okay, well, let's talk about the dollar, because the dollar's been kind of stationary. We've been kind of saying in our community, FX has kind of been asleep here. What do you do with the dollar?
I still think it's going to drop to the 104.40. The interesting thing, look at the RSI. Blake, it was really overbought 3 weeks ago. Now it's down to almost 50. And you haven't had much price erosion. That's one of the things that interpreting the RSI is important. In other words, we're working it off by going sideways. So if you get a dip to 104.40-ish, the RSI is going to be under 35 in all likelihood. In other words, it will have worked off the very significant overbought condition and become somewhat oversold. So again, I think there's another drop coming. And then I think the dollar is going to have another rally that takes it above 107.34.
That'd be interesting, because the dollar really has been fairly unresponsive, but there's so many factors that are plaguing this market right now. So it'll be interesting. Okay, the last chart is just the asset class that I have to hats off to you, Jim. You said we were going to come down here around 1850 or somewhere around here. We go higher. Don't know what the reason was, because you didn't have your palm reading suit on, I guess. But we've seen this really massive reversal. Is this the catalyst that can drive us to all-time highs?
I think the odds favor that. There was another count that the low at 1812 was wave A of wave 2, but both those counts said we're going higher. So that's cool. You got the bullish count says, well, a lot higher. And the quote unquote less bullish is, okay, a rally up towards at least 1980, which is that first horizontal trend line. And the way we've blown through these trend lines, to me, says, okay, making a move up towards 2031 seems reasonable. And potentially this will be wave 1 of wave 3. So you could see a $220 rally approximately for wave 1 of 3. Then you get a pullback of 80 to $100, and then you blow through 2050, 2070. It's classic wave 3 of 3, blowing through significant resistance. So this area 2050 to 70 has been hit 3 times in recent years. It's just classic wave 3 of 3, blowing through that. And obviously there's going to be stops up there. People, oh my goodness, look at gold. It's happening a little bit. So to me, if someone went long under 1850, as we get closer to 2025, 2031, is probably the right place to take off a third of the position, maybe a half of the position, because I think there's an $80 to $100 drop before you then get the subsequent rally that blows through that. So depending on somebody's time frame and all the rest of it, I think taking money off the table makes sense, and then look for a pullback under 1950 to re-enter.
Well, Jim, like I said, you've been spot on. And if anybody's, fortunate enough to have been trading gold and long, from those levels. You have a not so bullish count that could stall us before we hit new all-time highs. So take note of that. Jim, we appreciate you taking us through these charts and your ideas each and every week. And if you do appreciate what Jim does, make sure you give him a thumbs up. Subscribe to this channel. But Jim, the best way to get the most recent copy of your work, how do traders do that?
Send me an email, jimwelshmacro@gmail, website macrotides.com. We're going through a revamp on the website over the next handful of days. So it's gotten a very nice facelift. Awesome. And as we transition, there may be a day or so where we're not up 100% between the old site and the new site. So just letting you know that if you try to log on and you don't get the thing what you're expecting, it will happen soon. So hopefully by early next week at the latest, so.
Developing websites and software, it's kind of like when you remodel your house, and it's double the time and double the amount.
That's kind of what it's taken.
Yeah,
it happens. But I'm really pleased with the work that's been done. I think it's the information that's going to be made available is informative for people who want to check out, okay, what does this guy do, and get a better understanding, as well as providing information on, well, what has the calls been over the last 2.5 years? You can readily find that out. So great. Anyway, thank you.
All right, Jim. Well, we're excited. We're excited for that. I can't wait to see your new site. And thank you so much for spending your Fridays with us. And I will see you next Friday. Have a great weekend.
You too, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.